To me, the bottom line for gold is just look over it. Cold War 2.0 is getting hotter every day. The unlimited friendship between President Xi and President Putin is just kicking in. Bottoming, we have U.S. stock market volatility bottoming versus high T-bill rates bottoming from multi-year lows. And when that happens, gold usually outperforms. And just look at one key fact. The last time the Fed started easing in 2007 from similar levels, a year later, the S&P 500 was down 20% and gold was up 20%. Now, typically outperforms S&P 500. I just measured the last start of easing cycles since 1989. Gold usually beats the rock and is really beating the rock. So I look bottom line, it's gold. I expect some bucking in that bull market.
Over the 5-year period, gold has climbed an impressive 81.65%, outpacing even the S&P 500. Topline gold prices continue to skyrocket, closing last week at another record high. Several factors help boost the precious metal, which has actually outperformed the blistering stock market in 2024. Senior Commodity Strategist Mike McGlone at Bloomberg Intelligence notes that the intensifying Cold War 2.0, marked by stronger ties between Xi and Putin, is driving gold higher. He highlights that gold typically outperforms during Fed easing cycles, as seen in 2007 when it gained 20% while the S&P 500 dropped. During the major equity bear market and global financial crisis from November 2007 through February 2009, the equity market fell by 50.91%. In contrast, gold rose 20.58%, more than Treasurys and the US dollar, which gained 12.42% and 15.07% respectively. Commodities declined 42.25%, clearly failing to provide the safety net that gold did. Amid global shifts, Mike expresses that gold's strong upward trajectory will likely persist, significantly outperforming other commodities like crude oil. Over the past 160 years, the oil-to-gold ratio, which measures how many barrels of oil 1 ounce of gold can purchase, has averaged around 19 barrels per ounce, with a standard deviation of 8 barrels per ounce, said analysts at Bernstein in a note. Analysts at Morgan Stanley and Goldman Sachs are anticipating lower crude oil prices in response to OPEC Plus's plan to increase production, offsetting demand fears in the wake of Libya halting oil production entirely. Highlighting market extremes, Mike observes that the S&P 500 has reached its highest level compared to global stocks and gold since 2007. He predicts that a market shift is inevitable, with volatility at record lows, pushing investors towards safer assets like gold. Traders showed signs of indecision on Tuesday as volatile price action dominated most markets, except for precious metals, with spot gold extending its record-setting rally as it surpassed $2,660 per ounce for the first time in history. Now, we present the clips of Mike McGlone's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
We know where we're going with this one, gold. I mean, closely, because I have to admit, in the commodity space, it's nice to have something that's going up. And it's the only major commodity that is going up. I expect to continue to go up and has major sound fundamental technical underpinnings below it. Again, to me, the bottom line for gold is just look over it. Cold War 2.0 is getting hotter every day. The unlimited friendship between President Xi and President Putin is just kicking in. Bottoming, we have U.S. stock market volatility bottoming versus high T-bill rates bottoming from multi-year lows. And when that happens, gold usually outperforms. And just look at one key fact. The last time the Fed started easing in 2007 from similar levels, a year later, the S&P 500 was down 20% and gold was up 20%. Now, typically outperforms S&P 500. I just measured the last start of easing cycles since 1989. Gold usually beats the rock and is really beating the rock. So I look bottom line, it's gold. I expect some bucking in that bull market. I'm really concerned when you see the rock beating stocks on 1, 2, and 3 year basis, and there's so much enthusiasm for the equity market. The key thing I like to point out is just a little bit of reversion in a really expensive stock market, most notably versus gold, and gold just catching up to the stock market as a curve disinverts, as the Fed starts to ease and the U.S. tilts towards this recession that's been completely elusive. Is the current trajectories, I'm more fearful that it's going to accelerate. Well, here are key facts. Versus the S&P 500, the Bloomberg Commodity Index is the lowest in about 25 years. The S&P 500 versus the rest of the world stocks, the MSCI ex-US index is the highest ever. Versus gold, the stock market's the highest since about 2007. Those are just basic measures of over other markets. And I look at it versus a 100-week moving average, it's very stretched. Here's a key thing I like to point out. This metric made me a lot of money in 2008, and that is just look at the VIX Volatility Index. It's 52-week moving average minus the T-bill rate. That volatility measure is the lowest since 2007. That gave me the signal for the 2008 crisis. And the bottom line to remember is volatility is always mean reverting. The volatility in the stock market being this low is probably much better for people to consider profit taking, which they probably are. And I think that's part of the reason we're seeing this migration towards the rock metal. I look at it as a high price cure. It's basically about gold beating everything. You mentioned crude oil. Crude oil's had a decent dip into a 60 handle. It's down 20% on a 1-year basis. And crude oil's up about 35%, almost 40% on a 1-year basis to September, 23rd. And that's a trajectory I expect to continue. And I think the bottom line is it's really what's happening on a global basis is China. The Chinese government 10-year note yield at 2.04% is 170 basis points, below the U.S. It shows severe deflationary forces out of China. And you mentioned the Fed has started to ease. The good news is that might be good, but typically it's bad. If you look at the history, then just look at the last time the Fed started an easing cycle. It was actually 17 years ago on September 18th. And a year after that, gold was up 20% and the stock market was down 20%. So hopefully it's different this time.
Regarding the current gold market, Mike McGlone expresses concern about potential short-term risks, drawing parallels to 2008 when gold temporarily dropped before a strong rally. Despite recent volatility, Mike McGlone predicts that gold will reach $3,000 an ounce as hedge funds maintain strong long positions. Lower rates reduce the cost of holding precious metals, while a weaker dollar makes them cheaper for foreign buyers. Additionally, U.S. PMI data shows inflation rising faster in 6 months, further supporting demand for these safe haven assets. However, Mike predicts a short-term bounce in crude oil due to Chinese stimulus, but warns of long-term economic concerns, comparing China's situation to past peaks in the Soviet Union and Japan. Let's get back to the interview.
So you've seen that. The managed money net positions, hedge funds and futures are about 40% net long, which is compares that to the peak in 2011, which is 49%. So they're very long. I mean, but they're on board and they're about as sold out in crude oil as they've ever been, petroleum futures. But that's the trajectory. The key thing that's happening, I think, in gold is gold ETFs, which have been in pretty significant outflows since that peak in 2020, about 30 million ounces of outflows. Now it's turned back upward. So we might see a little bit of excesses in the hot money, which makes sense, but there are excesses in terms of where the trends are going. That's gold going up and crude oil going down. But I think the key risk we have now is this rapidly advancing U.S. stock market just having a little bit of back and fill. And we do have an election coming up, and it's not for certain that it will be that clean and clear. Remember, the contender has never really accepted the last election, and there was some violence and insurrections after that attempt for a peaceful transfer of power. So the market might be pricing a little bit of that in. But my bottom line is gold is a bull market. It's overdue for some bucking, which means it might drop to $2,400 an ounce. But I think it's just a matter of time it gets to $3,000. And I'll end with this. A key thing and key fact about when you enter potential recessions, and particularly when you have extremely inverted yield curves, I look at the 30-year bond versus the T-bill, still very inverted. Typically, when you have gold that is such a premium, the stock market, S&P 500, such a premium to gold. Just put the per ounces of gold on the same scale as S&P 500, which is basically it takes 2.2 ounces for gold. Historically, that's 1 over time. When you have such a premium in the stock market, they just kind of typically invert. I think that's what's happening. We just haven't seen that weakness in equities yet. I think the latter is more likely correctly. Obviously, they're seeing what's going on in China, plunging bond yields in China, the inverted yield curve, U.S. 10-year note yield at 373. It's still well below Fed funds, but they're legitimate positions. But the way to think about it is they're on board of significant trends. And they are, it's basically the equivalent right now in managed money net futures positions is about 25 million ounces of net longs. If there's a bit of a risk, like remember when 2008 hit, gold was up about $1,000 an ounce, it dropped to 700, and then it rocketed towards 1900 by 2011. We have risks of hitting stops in gold as people, have to sell what you can, but that would be a short-term blip for a longer-term bull market if it happens. So you have to be aware that if you're looking to get way overweight long at gold at these levels, you have to be aware of a little bit of liquidation risk. But overall, to me, the trend is quite bullish. It's kind of things you expect in a bull market. We will get stimulus. It's a matter of time. It's a matter of how much. And hope's never been a good trade. At least that's when I used to have hair trading. That's the problem. The fact that they have to depend on stimulus for stabilization. The fact that we have to depend on OPEC to increasingly add to a spare capacity and cup supply for crude oil to rise is part of the major problem in commodities. So those are part of the trading things that you fully expect. And that's part of the reason as a trader need to be nimble with crude oil having sold out completely. I think traders are more kind of waiting for a bounce to sell into, particularly if we have more signs of stimulus from China, which we will have. They kind of have to. But the macro big picture is overwhelming. And that is, I look at China, as I've been pointed out for years, is very similar to peak Soviet Union and peak Japan almost 30 years ago. The thing is, it's just much bigger, much wider, and President Xi, I think, made the mistake of cozying up to the wrong dictator.
Experts are bullish on gold for October, despite some market uncertainty. This latest price surge reaffirms gold's status as a sought-after asset and positions it as an attractive option for those who want to earn quick returns on this traditionally long-term investment. With gold historically outperforming the S&P 500 during periods of market stress, do you see gold as a stronger investment soon? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.